Hello, everyone, and welcome to Pensionmark's September webinar, where we'll be discussing how to invest wisely. We appreciate all of you taking the time to join us today. We have a few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. And at the end of the presentation, we will take some time to go through these. Now I'd like to introduce our guest speaker of Invesco, Tracy Fielder. Tracy is the Product Management Director for Invesco. He works with Invesco's U.S. value investment teams and client portfolio managers to develop sales, marketing programs, positioning Invesco's product line across all global distribution channels. Mr. Fielder entered the financial industry in 1993 as a marketing coordinator. He earned an MBA from Houston Baptist University and a BBA cum laude with a concentration in finance from the University of Houston. He holds his Series 6 and 63 registration. Thank you so much for joining us today, Tracy, and now I'll turn it over to you.
Thanks so much, Tori. Okay, folks, well, thank you so much for joining us today, and I apologize for starting a little late. We had some technical difficulties dialing in, but that being said, I think we should go ahead and start off right away. We'll go ahead and move to this slide, and I think most of you out there should be familiar with this image. For you Eagles fans, know it's not Tim Tebow. That's the pose he used to strike, but fortunately it doesn't look like, or unfortunately it doesn't look like Tim Tebow is going to find a home in the NFL this season. But in all seriousness, this is actually the famous statue called the Thinker, and it's probably one of the most famous sculptures in all of art history. And it was created by the famous French sculptor Rodin. And it really depicts a man, if you can see, in sober meditation, and apparently he's battling with this internal struggle. Well, one of the things you may not be aware of is that Rodin originally intended this sculpture to represent the great Italian poet Dante Alighieri. Now, Dante wrote the 13th century poem, The Divine Comedy, and it tells a man's journey from hell to purgatory and then eventually to heaven. Well, Rodin was asked by the Museum of Decorative Arts to create for them a grand entryway to the museum. And actually, it's actually a large wooden doors, if you will. And Rodin actually decided to display a scene from Dante's novel, which was the first chapter called the Inferno, or Dante's Inferno. And so he carved this scene of hell, if you will, on the entryway door. And he decided to take a miniature version of the Thinker and he put it on top of that door. Now, I did this for two reasons. The first, he did it because he wanted to show Dante reflecting on his own work. And second, more importantly, he wanted to show Dante contemplating the fate of mankind below. Now, similar today, I know many of us are reflecting upon our experiences in the markets, and I would suspect, giving some of our experiences, myself included, that many of us has probably been at one point or another in an investor inferno. And I'd hope that today, with the markets where they've recovered, although yesterday wasn't any good indication of that, but basically speaking, the stock markets have been up for the past 6 years, that we've at least elevated to the purgatory level. And so today's presentation, what I'd like to do is provide you some insight to prevent you from moving back into that Investo Inferno, if you will. Now, Invesco has actually been thinking about your journey in investing and then the role that we would play in that. And at Invesco, we've also been battling with an internal struggle, much like the Thinker. And that struggle really has to do with the disconnect between the expectations that we set as an industry versus the reality that you guys see in the markets and investing over the past decade, 10 to 15 years. And we think that you can trace that disconnect, the root cause of that, back to the bull markets of the 80s and 90s, because back then, much of what was created to be considered conventional wisdom is really what we would consider myths and mantras. And so some of these myths and mantras, I'm sure many of you have heard today in and out of investing. And so some of the things you may have heard is, it's not a loss until you sell, or it's not market timing, but timing the market. And then a couple that we're going to look at today are like, don't miss the market's 10 best days. And then an overarching mantra that you see throughout the industry is invest for equities for the long run. Well, some of these mantras really become so iconic that they're rarely, if ever, openly questioned. And if they're followed, a lot of times that these can lead to faulty portfolio construction and ultimately poor outcomes for investors. So in response to that, Invesco has really set our sights on becoming a leader on a philosophy we call intentional investing, and this really has three core principles. The first is think carefully before you invest. The second is plan thoughtfully before you invest. And the third is act intentionally when you invest. And the Rethinking Risk program is really just a part of that overall philosophy. Now, in contrast to intentional investing is accidental investing. That means nothing more than negative unintended consequences, and often as a result of following conventional wisdom that we talked about. So today we're going to do a little bit of myth busting. I'm sure you folks have seen Mythbusters on the cable TV, and so we're going to go through this. And so moving on to the next slide, we're going to talk about some myths and corresponding truths that we've come up with at Invesco. So the first myth is that many investors think that their portfolio is going to benefit if it has more positive years than negative years. But the truth is the magnitude of those gains and losses counts much more than their frequency. So I'm going to talk to you a little bit about why the industry overemphasizes that frequency concept. Second one is I think people think if they miss the market's best days, outperforming the market is the worst thing they could do to their portfolio. But the truth is the market's worst days, the negative days, are just as important and probably even more so. And we'll talk to you why that is so important, about why that's so important. The number three is I think a lot of times people, and I get asked this all the time, the secret to getting rich is picking the right investment at the right time. What's going to be, do I invest in oil now because it's cheap, or do I invest in gold? You know, I heard this back 5 or 6 years ago before it came down. But the truth is really when you do the math, it's contributions or savings that form the foundation of a portfolio's value and the secret to building wealth. Fourth is that many investors really kind of look at the ability to invest in time economic events. And so I think they have time to prepare for something like a recession or inflation or even a bull market in equities. And they oftentimes get it wrong because they forecast this based on the most recent experiences in the market, whether they're good or bad. But the truth is prudent risk management means always being prepared for a variety of market environments. And then finally, a myth is that people think to diversify by owning different kinds of stocks. I own small cap stocks, I own large cap stocks, I own growth stocks, I own value stocks, I own international stocks, I own domestic or U.S. stocks. Well, that's important, but true diversification on the truth side is based on sources of risk, not on sources of returns. So let's move over and go on and move to the first truth here. Oops, let me back up once here. And this is the magnitude of gains and losses counts much more than the frequency. So this really means that your portfolio should be counted by gains and losses, magnitude of those gains versus the frequency of those gains. And this means that the market, or more like your portfolio, should be scored more like golf than tennis. So the very first statistic you see, the market's up the majority of the time. I'm sure many of you have seen this in some type of sales materials, or you've seen it on websites, or even on advertisements. And basically, out of the 89 past years of the S&P 500, 65 years have been up or positive and 24 down. And so investors see that and they think, well, my portfolio should be better, right, if it's up more than it is down. But that's not necessarily the case. And so let's take a look at the last decade of the 2000s of the S&P 500 to see why that's not the case. And so the middle score in the 2000s, winner or loser, is really just the calendar years of the S&P 500. Now, if you score on the bottom left, looking at the match play score, like the tennis player, I'm not a tennis player and I don't know a lot about it, so I'll keep it simple for my own benefit. But a tennis game or a match is won by the one who wins the most sets. And so it doesn't matter if you win the sets by 1 point or a lot of points, the one that wins the most sets wins the match. And so with 6 up years and 4 down years the last decade, the match play score, the tennis player, says that's a winning decade. Well, we all know that the golfer has a different view and looks at the total stroke count, not how many holes you win, unfortunately. And so if you're playing golf with a buddy, you accidentally blow the second or third hole in the back 9, you completely blow a golf game. So I would like you to to look at this through the eyes of a golf player. The stroke play score really tells investors the true magnitude of those losses for that decade. The total cumulative return for the S&P 500 for that decade was negative 9%. Now that really makes you scratch your head and wonder why many people in our industry continue to advocate that investors score their portfolios like a tennis player when really you really meet your score or meet your financial goals and should be scored more like the golf player. The point of this whole exercise is that frequency is important to a degree. You want your portfolio managers to consistently outperform their benchmarks or their peer groups, but ultimately it's going to be the magnitude that really helps you reach your financial goals. And so our point here is why overstate frequency when really we meet or we don't meet our financial goals by the magnitude of our returns. Because ultimately, none of us can execute a financial goal by cashing in a batting average. Now, due to time's sake, I am going to go ahead and skip through the second slide here on this and go to the second truth here. And this is that the market's worst days are just as important as its best days. Now, conventional wisdom tells us that investors need to stay invested over time and avoid market timing strategies, and which we agree with, absolutely, and we'll talk a bit about that. So they don't miss out on the market's top performing days. And investors are really warned that they're going to drag down the value of their portfolios if they miss those 10 best days. This is a big selling point in the industry. The problem with that is, with focusing is only on half the story, the market's highest returns. And the problem is it emphasizes the effects of the best days while entirely ignoring the effects of the worst. So if I walk you through the top, starting from the total cumulative return of the S&P 500, all the days from 1928 to 2014, if you invested $1, that dollar would have grown to $116 and change. Now that's all the days, the best days and worst days and in between. If you miss the 10 best days, like the sales literature tells us, that dollar would have only grown to $38 and change. So basically a third of the original value. That's where the warning comes from. Don't miss the 10 best days. But here's where the point we want to make, and this is a big part of rethinking risk. If you miss the 10 worst days, that dollar grows to over $365, well over 3 times the original amount of the dollar invested. The point here is really this, is that losses have a hugely, exponentially disproportionate impact to our returns versus gains. And then finally, if you miss the 10 best and the 10 worst days, you actually kind of reduce volatility by missing the peaks and the trough, and you actually have a slightly better return than just a passive investment in the market. And then finally, we would not have wanted to invest it in cash alone because a dollar invested in cash wouldn't have even given you a $20 bill at the end of the day. So let's explain to you why the market's worst days are just kind of this whole idea, the 10 best days. The sales idea is really kind of a silly premise. If we take the best and worst days, the 10 best and 10 worst days, and put them on a timeline going back to 1929, you can clearly see here that the best days and the worst days fell in such close proximity to each other that it's really impossible just to miss the best days without missing the worst days. And not surprisingly, if you look at 1929, 1931, 2008, most of the worst days fell during secular bear markets, but if you look closely, you can clearly see that some of the best days did as well. The point here is that this is statistical shenanigans. And the point here is also is that you can pretty much throw the idea out of missing the 10 best days when we realize it's really impossible just to miss those 10 best days. And that idea is kind of completely lost on behind this, especially now that we've established that losses have that disproportionate impact. That's the most important part of missing out on those losses. So the problem with this conventional wisdom is that it incorrectly defines risk as missing the upside. Because I know all of us want to outperform the stock market on the upside, but the point here is we really need to protect on the downside, as you can clearly see. And so by focusing on half that story gets us to kind of miss the bigger picture. And so we think that you should remain completely invested. We believe in that wholeheartedly. But make intentional choices so you can have your portfolio designed to participate in the up days or the best days, but even more importantly, to protect yourself on the down days. Because our end goal is really to meet the financial goals, our objectives, and not simply to be in and out of the markets on certain days. So when it comes down to sitting with your financial plan and with your advisor, really our investors, our first priority should be to minimize risk and not chase maximum returns. Now the second, this is basically the best and worst stage just in table format, so you can see here. So let's go ahead and move on to this part. Actually, I want to get to this because for time's sake, because I think this is more important, one of the more important pieces of the second truth. This has to do with retirement, and I believe that this is a very important piece. This is a client-approved piece, and we actually have this available on Invesco's website under our Rethinking Risk area. And this is called the sequence of returns. And the point of this is, this has to do with the issue of path dependency, which is compounding gains and losses. Well, that becomes even much more important when you're seeking to produce an income stream from your portfolio to fund your retirement living expenses. So if we can translate this into how this works into a financial plan, consider this example that I have for you on the screen. So for this scenario, we have $1 million portfolio invested in the S&P 500, and we're making 5% withdrawals. And we adjust 3% a year to adjust for inflation, and we go back 20 years. And for this scenario, let's make this two retirees. Retiree A would have the red line, and retiree B would be the blue line. And for each retiree, we show two sequences, return sequences, showing the exact same annual returns, but here's the key, folks, in a different order. Now, even though they're in a different order, both returns, arithmetically speaking, still result in an annualized return of 9.45%. Now, as you can see, that even though the compound annual returns over the time frame are the same, the actual order of the returns makes a huge difference when you're making withdrawals. So I'll walk you through this. Retiree A gets the return stream from 1990 to 2010. And so if you're walking through, imagine this person invested through the early 90s all the way through the tech and telecom bubble. The tech and telecom bubble burst in the early 2000s. They lost some money at the first downturn. The recovery happened in the mid-2000s, and then we had the great financial crisis, and we'd lost money again. But retiree A ended up with almost $3 million. They're doing okay. So if we look at retiree B, they get the bad end of the deal. Even though that their average rate of return was the same if you just took those numbers, when you're taking off withdrawals, we can clearly say that makes the biggest difference. Retiree B goes from 2010 backwards to 1990. And so that because they took a hit early on, going from 2010, and they took the hit in 2009, 2008, and then again back in the tech and telecom bubble, eventually halfway through this, you can clearly see that they're about halfway down of their original $1 million that they've invested. This client has two issues to deal with. First is the financial impact of losing half your money. The second is the financial impact of losing half your money. And we see this all the time. These are clients that are scared out of the markets and sitting on the sidelines. And they actually miss out on the bull market and recovery after the resulting bear market experience that they've had in the market. So the point here is,
Hello, everyone. It appears that we are still experiencing some technical difficulties as Tracy just cut out. My sincere apologies. If you wouldn't mind just hanging on the line for just a couple minutes, we'll see if we can't get him back up online. Thank you so much for your patience, and we'll be right with you.
hello, Tori, can you hear me? Can you hear me? I'm going to assume that people can hear me. I apologize for the technical difficulties. So I'm going to pick up here where I left off. But the bottom line is to pay attention to those losses early on. Although we need a reasonable upside potential in retirement, we certainly want to make sure that we protect on the downside. So moving on to our third truth is that many people think that they have the fortuitous and the way and the luck to actually pick the best investment to become rich quick, right? But we're going to see here quickly that the contributions and savings really form the foundation of wealth. And so here in this example, we have a household with a $100,000 income, a 10-year horizon, with three different market scenarios. A 10%, the 10% savings rate is across the board. We have a bear market with a 0% market return for 10 years. We have a 6% market return, which we would say is a moderate return over a 10-year time period, and a bull market return of 12% over that time. So what we'd like to see here is what happens. And so we can clearly see with a 0% market return on the left, when the red column is, 100% of the wealth is built on contributions. In the moderate market, at a 6% level, which is still a decent rate of return over 10 years, we can see the vast majority of the wealth is still comprised of contributions. Even after a 12% compounded rate over a 10-year time period, the majority, even though a small majority, is still comprised of contributions. And so we can clearly see that the savings is the growth engine. And so we need to understand how impactful this is when we're trying to save and making sure that savings is our growth engine. Well, a lot of times when I do this, we say that this would not be necessarily a long enough time period. And so what we will do here is to see, let me check here to make sure I can get, I need to move to the next slide here. So, okay. Here we have two different households. I think this is the best one that really takes this kind of to where the rubber meets the road. We have two households in this case. Both have a $100,000 income. Both have a 10-year horizon, but the first household saves 10%, but they're an excellent investor. They've averaged 12% over that 10-year time horizon. These are the folks that are going to be bragging at the Super Bowl party, right? So they've done for themselves, they've basically taken $100,000, 10% times 10 years, which has taken $100,000, and almost doubled that to $193,000 and change. Again, they did very well for themselves. The second household didn't know what to do with their money. They look at the market. They heard their friends of losing half their money in the stock markets. They actually heard the Ponzi schemes, right? So they didn't want any part of that. So they stuck their money in their mattress, or the equivalent nowadays. The equivalent of nowadays is their savings account. But they invested 20%, or they saved 20%. And the super saver here basically bested the excellent investor by over $6,000 because they saved so much. The point here is that we like to focus on things that you can control in rethinking risk. What I would like to say with this is the two things you can control is, first is your savings rate, right? We can control that to a degree. The second is, once we save more, that shows that we can have a more conservative allocation. That means we don't have to take so much risk in the market because we're letting the savings do the work for us and not relying totally on the stock market to do the work for us. So remember, two things that we can control is our savings rate, and the more we save, the more conservative of an allocation we can have. Conservative allocation does not mean 0%, however, because if you invested in cash, as we saw earlier with the missed the 10 best days example, that cash would erode over time your purchasing power due to the effects of inflation. Okay, so let's move on to the fourth truth and get towards portfolio construction, because I think this is really probably one of the more important areas that people want to understand. The fourth truth is prudent risk management means always being prepared for a variety of market environments. And so if you remember when we were earlier kind of going over the truths and the myths, I said that many investors kind of try to think they prepare for events as they unfold. They have time to do that. And it's because they aren't imminent. And so they think this is something like a recession or an inflation or even I mentioned a bull market in stocks. The point of this exercise is these events can have catastrophic impacts on a portfolio if the investor is not prepared. So consider these quotes about hurricanes and read them. Now, if you lived on the coast, I live in Houston actually, and if you read these statements, I can guarantee you I'm not going to call and cancel my flood and wind damage insurance because even though the probability of a hurricane is low, the potential for the damage is so much that I don't want to leave myself unprotected. And believe me, living in the Houston and the Gulf Coast area, in less than a 24-hour time period, it can be clear, and then all of a sudden we see a tropical storm or a hurricane barreling down on us, and that's no fun. So we definitely want to make sure we stay protected. But what if I told you this, that instead of the word hurricane in this is actually quotes taken from the financial media from 2006, late 2006 and 2007, with one important difference. You replace the word hurricane with the word recession. And in that environment, if you think about that, back in the 2008-2009 debacle, the great financial crisis, many investors left their financial houses unprotected. What they did is they avoided assets like long-term government bonds and cash. And these things, the asset classes have historically held up well during recessions. And what they did is they positioned their portfolios for sustained economic growth through stocks and equity-like investments. And what happened was their portfolios took severe hits. When the economy slipped into a recession, the markets plunged, and most of those equity-like investments all correlated together, and they all dropped about the same rate, and so people lost. The problem with this is that many investors disconnected the probability of a recession from the impact of one. And so for those of you familiar with an insurance industry, I used to work for an insurance company before I came to Invesco. I realized that actuaries or insurance companies like to insure a high magnitude event, even if it has a low expected probability of it occurring, just because of that impact. The whole point of that is that impact. And unfortunately, many investors take an all-in or all-out approach to their investing, meaning they go all in stocks or all out of stocks, or all into bonds or all out of bonds. And we have to be careful of that because you're really timing when you're doing that. Prudent risk management means being prepared for a variety of economic possibilities. And so the message here is just don't leave your financial houses unprotected. So that really leaves us with the question, how do we prepare our portfolio for various economic environments? And so that kind of brings us to our final truth, which is true diversification is based on sources of risks, not on sources of returns. And so earlier on in the presentation, at the intro, I said that there's a mantra that runs throughout, and it says that invest for equities for the long run. And I think you could actually trace that type of mentality in the industry back to a chart just like this. Nothing wrong with this chart. It's a Morningstar chart, and it simply shows the major asset classes of stocks and bonds and cash, which is treasuries in this case, versus inflation. And as you can clearly see here, that equities have outperformed over time, right? And that's the light blue line on the top. We would expect that to be the case because of the equity risk premium. Investors should be compensated over time for that. However, one of the things that we do when we're taking risk is study extensively market history. And so while equities have historically outperformed over time, we all know this, that they don't outperform all the time. But by studying that market history, we know that some of the periods of underperformance in the past can last significant periods of time. We want to show you that. And so what that means for us is the implication of those periods of underperformance can have a significant impact when we look at through the context of our individual financial plans and time horizons for things like retirement. So instead of taking a dollar, investing it in a major asset class and allowing it to compound to infinity like the chart we just saw, what we did here is we took the major asset classes and we showed how they reacted or how they performed in each of the major economic environments. And so we'll start on the left. From 1929 to 1941, that was the Great Depression era. That was a deflationary period, and we can clearly see that bonds led the way. The same to be said on the very far right, the 2000 to 2014 time period. We had deflation-like time period where interest rates have been held low artificially by the Fed keeping rates low, and it's been a tailwind for bonds, so they've outperformed. Now gravitate towards the middle, an inflationary time period from 1966 to 1981, 16-year time period, where inflation outpaced cash and it outpaced stocks. Now, if you move over right to the right of that, the 1973 to 1981 time period, 9 years, we carved that out because that was the first year in 73 that the commodities index was incepted. And now you can clearly see that in that 9-year time period, the commodities were really the only major asset class that outpaced consumer prices, which was inflation, outpaced cash, which is represented by T-bills, and all three of those outpaced stocks. Now, if you move to the bookends of those, 1942 to 1965 was a bull market of 24 years. In 1982 to 1999, which was mainly the tech and telecom bubble of 18 years, were good times for stocks. That's 42 years that stocks outperformed. However, this whole entire patch quilt, if you will, it encompasses 86 years. So 42 out of 86 years is less than half the time of the other time periods. And you can clearly see that some of these time periods are very long. So the question is to us is, would we want to own a portfolio that's only going to be led by stock performance for all of these time periods and still meet our financial goals? Well, the reality of that is we probably want to consider something else. So as we looked at this, true diversification is based on sources of risk. Well, what are the sources of risks? The sources of risks, in our eyes, are the shifting economic environments, the inflation, recessions, and low inflationary growth as bull market equities. And so here are three major economic areas that we can see here that we would probably want to own different asset classes that have performed historically well in these economic environments. And the point of this is not have a single asset class like equities dominate the outcome of our portfolio. And so we can see here on the left under inflationary growth, we've already discussed commodities in that period, so good enough. Direct real estate, notice that's direct real estate. That's brick and mortar, not REITs, to be confused with a mutual fund where you can invest in REITs, or Treasury inflation protected securities or TIPS. Under recession, we have long-term government bonds. You could put cash there, although we do kind of warn against using cash as an allocation tool. That's really more for liquidity purposes and investing opportunities. And to the far right, we have low inflationary growth, or bull market stocks, and that's, of course, stocks, private equity, or anything highly correlated to stocks. That could be something like high yield or junk bonds, or emerging markets bonds, or international bonds, things of that nature. And so we can clearly see here, this kind of gives us a simple framework to work with when we're looking at diversifications. If you look at the right, you have to own stocks, right, for the growth engine of your portfolio. You have to have that. But here's the key, and this is something that the industry really doesn't teach us. We have to be aware of, acknowledge, and account for the two things that can derail that growth, which are really inflation, which we haven't seen in some time now, or recession, which we did have a horrible one in 08, and actually late 07 through early 09. And actually there's really a third risk. The third risk is being scared out of the markets altogether and sitting on the sidelines from your bad experience because of a recession, which we've had recently, or back in the day with inflation. And you miss out on a bull market in equities. And I've actually seen many clients that are still trying to wait to when to get back in the market after the 08 and 09 downturn, the bear market we had, which was a really horrible one. It was the worst we've had since the great financial crisis. And so really the point of this, folks, is we want to own different asset classes that are going to have a different way to perform in these different economic environments. And we don't want to just be solely dependent on waiting on an equity bull market to occur just in time for our retirement. Now, we went through a lot of different things today, so I want to kind of summarize this for you folks today and open up for questions. But the first thing we walked away is understanding the market scoring system. We want to score our portfolio, actually, like the golfer, by the magnitude, not the tennis player. Nothing against tennis players, but not the frequency. And we want to make sure we design our investment strategy accordingly. Number two, remain invested. We can't time the market to try to get the best days or the worst days or what have you, but we want to seek to avoid our catastrophic losses. Remember, losses have a disproportionate impact to our returns versus gains. The third, the secret to getting rich, building wealth, and you folks should, this is a really key for you folks listening to this on the pension side, especially retirement. Maximize your contributions, and then build your goals based on realistic savings assumptions and not unrealistic market assumptions. Number four, be prepared for the unexpected. We don't know when we're going to have inflation again. We haven't seen it for some time, but it will probably arise its head again, and we don't know how long it'll be here, or recession, or bull market in equities. We don't know how long they last. And finally, diversify your investment portfolios by sources of risks. Look for things that behave differently in different economic environments. so that you're able to hit your financial goals in a variety of market environments. And again, not simply waiting around for the next equity bull market to occur just in time for retirement. Now, that being said, I'm through. We got through that. I'm sorry again for the technical difficulties, but I'd like to turn over to Tori to see if you folks have any questions.
Thank you so much, Tracy. We will now start addressing some of the questions that have been filtering in. Audience, please remember that if you do have questions, you can submit them using the Q&A tool on your webinar menu. And as always, you can reach out to your dedicated service team at Pensionmark for any plan-specific questions. You can also visit your Financial Fitness Center or the Online Education Center for different newsletters, financial wellness quick tips, webinars, financial calculators, educational videos, and social media. So Tracy, our first question. Oh, go ahead. Our first question is, the more you save, the more conservative allocation. This is a statement that you made in the presentation. Why is this so important?
Well, that's a great question. And the point of this is, as you saw when we had the person that saved the 20%, they outperformed or had more savings, not outperformed. They did more savings or actually had a bottom line bigger nest egg than the person that made 12%, just by saving 10% more. So if somebody saved 10%, they made 12% returns, they made less than $200,000. However, the person that saved 20% at a zero rate of return bested them by over $6,000. Now, what that really means in just really easy layman's terms is to say that by saving more, you're making your own growth engine. By saving more, you're the one driving your wealth building, and you're not solely relying on the whims of the market. And by saving more, you wouldn't certainly want to have a 0% rate of return, but you don't have to be 100% equities, and that's kind of the whole point of the exercise throughout here. And it means you can take less risk. By taking less risk, then when we do have a market downturn, like we had yesterday and we've had back in late August, you're not subject to the full brunt of the market. You can invest in bonds. You can invest in more conservative things, and use your savings vehicle or your savings contributions as your growth vehicle for retirement. And so the key here is, if you can, as much degree as you can from a budgetary standpoint, maximize your contributions in your retirement account, because that's really going to grow your nest egg more than anything else.
Great. Thank you, Tracy. Our next question, how do you avoid major loss days, and when do you know to remain invested?
Well, the key to avoiding the major loss days is kind of towards the very end. We talked about true diversification, because we don't know when those markets are going to occur. I mean, yesterday nobody saw that sell-off coming. The late August, nobody saw the sell-off coming. Nobody knew that oil was going to go from $100+ a barrel back in June of last year to actually hit below $40 a barrel not too long ago, back in mid-August. These are kind of things that nobody can predict. In fact, I always like to tell people half-jokingly, if I could predict those things, as much as I love my job, I wouldn't be working here. I would be on an island somewhere. And so the point is to be really truly diversified. And so avoiding those worst days is more about diversification, to make sure that you have something working with you when the stocks are going down. So for a good example is, I did some research when the stock market was down around 12%, long-term government bonds were up 7%. So instead of you being 100% in the stocks, if you would have owned some longer-term bonds or even intermediate-term bonds, you would have not only offset your losses from not taking a loss, but then you would have offset it because you actually had positive rates of returns in bond market. And you typically see that in losses during sell-offs in equity markets, what we see is risk-on and risk-off trades. Risk-on is when stocks are doing well, and the most riskiest stocks are doing well. Technology stocks typically do well. Smaller company stocks do well. Emerging markets like China, India, places like that, Russia do well. Risk off is when those emerging markets, like the recent sell-off we had, is because China's slowing down, and so we saw emerging markets sell off heavily. So people took risk off the table. They sold off in those areas. Where do they go? Well, they go to a flight to safety, and they really gravitate typically towards government bonds and U.S. government. Even though we got downgraded a few years back, we're still the best out there in terms of debt ratings as far as sovereign bonds. And so people will gravitate to that. So when stocks sell off, government bonds are typically going to do better than that. So that's just a very simplistic way to look at trying to protect yourself from the downside.
Thank you, Tracy. Our next question, can you please explain stay invested but protect from loss?
Sure. I think I answered it partly, what I just said. The point is to be diversified, if we can remember that. And so the point is in the past, everybody, and again, that 80s and 90s mentality, I grew up investing in the 90s part of it anyway, is that you wanted to be invested in all stocks because the last thing you want to do is miss out on those tech and telecom. When, you know, some stocks were making 300 or 400% a year, like Yahoo back in the day, and Dell Computers, Microsoft. And people did that, but what happened was when the market tanked, when those tech and telecom stocks started going down, everybody was in stocks. And so when you're nothing but stocks, the only way you would prevent stocks was get out of stocks, right? And that's the market timing. You prevent that by not being all invested in stocks. As I mentioned earlier, when you have a flight to safety and stocks are selling off, if you own something as simple as government bonds, you can greatly offset that loss, and that way you can stay invested. So as opposed to being down when we had 12% downturn in the market recently in August, you could have had a 60-40 portfolio or 60 of stocks and bonds, or you could have had 50% in stocks and 20% in bonds and 15% in cash or something along the lines of that, and you wouldn't have had the full brunt of the market being downturn. And say you were down 6 or 7% versus 12. It's a lot easier to stomach that downturn. Therefore, you'll stay invested. So again, back to the key is to stay diversified for when the market sells off. You're not taking the brunt of being all in stocks, and it's so painful that people want to sell out. Therefore, you'll stay through the ride. You'll handle the bottoms better because you won't be down as much as the stock market, and then you'll be able to survive coming out of that. Because again, what do we say? That losses had that disproportionate impact versus our gains.
Great. Thank you so much, Tracy. It appears we have no additional questions at this time, so we will now conclude today's webinar session. Thank you, attendees, for your participation today. Also, thank you for your patience. Tracy, it looks like we have one more question that just came in.
Sure.
That question is, are you an advocate of annuities as a form of diversity?
Yeah, I would say that. It's funny you asked that. I actually worked in an variable annuity company before coming to Invesco for 10 years, and I specialized actually in defined contribution plans and record keeping, and I actually consulted with plan sponsors. So my background certainly I have a lot of experience with that. Annuities, what they do provide, there's some out there that are against them because of expenses and things like that. The way I look at it is, it's a form of insurance. An annuity simply provides you a guaranteed stream of income. And what that does as far as diversification is you have steady income coming through for retirement especially. And at that period of time, you're diversifying your income stream. And so then you can put your money some in the stock market. You can put some of your money in bonds. You can put some of your money in commodities or real estate or some other things like that, and truly diversify your portfolio, because at least a part of your income stream is coming in from annuities. So definitely, annuities can certainly be a part of a diversified portfolio, particularly in retirement. So I'd wholeheartedly agree in that.
Great. Thank you so much, Tracy. Again, we just want to thank you, participants, for your participation today and also for your patience as we worked through some of the technical difficulties. Thanks for hanging in there with us. And
yes,
I hope everyone has Thank you again, everyone. Thank you, Tracy, for your time. Hope you all have a great rest of your day. And we will see you for the webinar next month in October.
Bye, everybody.